Welcome back to my YouTube channel, Victory Reverse Mortgage. I'm Benny Victory. Today is Tuesday, December 6th, and in the 31 days of December, I'm making one video a day. Today's video has to do with the concept of when you're getting a reverse mortgage, the first and primary question is, how much money am I going to get? And this comes from a place because obviously it's important, but people are used to asking, what's my loan to value? And reverse mortgages don't work like that because they use different factors. And because of what's happening right now in and around reverse mortgages, which is primarily having a negative consequence, interest rates have become higher and are being increased. And that is indirectly and directly affecting real estate market. So appraisal values are coming down. And interest rates going up could potentially mean that less money is available. On a traditional side, interest rates going up make your payments higher and make the cost of borrowing the money more. But when it comes to reverse mortgages, higher interest rates, what they do is they have an adverse effect on how much money you can borrow. So because of that contrast between the forward mortgage and a reverse mortgage, I thought it's prudent that we discuss and compare the two sides. Now, today's going to be pretty much devoted to the reverse mortgage and breaking it down. And then tomorrow, I'm going to do a little bit more of a detailed dive in comparison to what the forward mortgage looks like. Now, the primary and most obvious thing that both forward and reverse mortgages share in common has to do with the property value. So when we do an appraisal, we determine the loan amount. The other factor that goes into it is the interest rate. Now, again, the reason I have the red asterisks in there is that because of the Fed rate increases, these two things have become a little bit different than they were where they were 6 months ago. Where 6 months ago interest rates were lower, now they've come up. Where property values used to be higher, now they're beginning to come down. And that makes a difference on, again, your borrowing eligibility. Now, the interest rates on a reverse mortgage, there's two programs. There's an adjustable program and there's a fixed rate program. And the benefit of the fixed rate program is just that. The interest rate doesn't change from month to month, year to year. Whatever it is, it's going to be. Now, the reason some people get the fixed is for factors that I'm going to discuss here, but there's also an adjustable program, and that adjustable program is something that changes. The rate is fluid depending on market movement and interest rates. So the one thing I do want to distinguish with the reverse mortgages compared to the traditional forward side is that your credit score is not as impactful on your interest rate. But on the forward side, it makes a significant difference. In other words, someone that has an 800 FICO score compared to a 580 FICO score is given a different treatment, different rates, different program parameters, whether it's loan to value or combined loan to value. But as it relates to reverse mortgages, your credit score most likely will affect us looking to see what your payment pattern has been, and that has to do with determining whether a future escrow account should be set aside to collect taxes and insurance. Because a low credit score could be indicative of someone who has a hard time managing their timely payment of their obligations, not just their mortgage, but their obligations. And because we don't want taxes to be impacted or taxes to be missed, that may be a reason why we wouldn't want to have an impound account. But that's a separate and more detailed conversation on a case-by-case basis. As it relates to the adjustable interest rates have two factors. There's a margin and there's an index. A margin is a set amount, a set number, a set percentage rate, and it does not change. So whatever the margin is, it's going to stay. The index, however, does move. Like LIBOR is an index, the CMT is an index, the prime is an index. So indexes can move up or move down, and based on their movement, then the actual interest rate changes. Now, one reason I alluded to someone getting a reverse mortgage with an adjustable interest rate has to do with determining what their big picture in terms of their home equity and their existing loan amount looks like. And if you could think of it in three separate examples. Let's say you have three neighbors living side by side. Neighbor number one has his house paid for and it's free and clear. And so the conversation with that neighbor is that you don't owe any mortgage on your house and it's free and clear. We should get you a reverse mortgage. And the reason we want to do that is that we want to establish a standby line of credit. And that standby line of credit, what it will do is that it will be in place, and when you need it, you have it to draw on. And the benefits of that, as I've discussed in other videos, is severalfold. But the first and foremost is that when you establish the line of credit today, starting today when the loan closes, that line of credit can increase and give you access to more cash equity appreciation in the house. So if you know that you're not going to need it and you're getting it as a standby line of credit, when you get it and it's in place now and it just sits there for 5 years, based on this interest rate, this adjustable interest rate, that line of credit is actually going to increase. That's one factor. That's one big plus. Another one is that once the loan is closed, if property values start going declining, then that line of credit is not going to be affected or impacted, which is a huge plus if you think about it, because that's not offered in the home equity line of credit, which is a HELOC. So that's neighbor number one. Neighbor number two is someone that has a mortgage, but they have a $100,000 balance, and let's say their property is worth $1 million. So they have a tremendous amount of equity in the house. They have a very small balance. And by paying off the mortgage, they automatically are going to eliminate their monthly mortgage payment. And they too will be eligible to get a standby line of credit. So they're in a similar position as the first one is, but they have a small balance. The third neighbor is someone that when we do the calculation, we determine that based on their existing loan balance, what we're going to do is we're going to pay off the loan and there's no more opportunity for establishing a line of credit. Now, this scenario with these three people will have three separate consequences. And for the first borrower, his balance only is going to start with maybe the line of credit, the cost. So I put in $15,000. So if we say the starting loan balance for him is $15,000 and the available line of credit for him is $300,000, if he's not making monthly payments to pay anything on this $15,000, his $15,000 balance is going to grow based on the interest rate, and his $300,000 line of credit is also going to increase by the interest rate. So it's a huge benefit for him to have it in place and get it started, because it's going to increase and it's going to grow and it's going to just give him a tremendous amount of borrowing power. Second neighbor has a higher balance at $100,000, but he still has a $200,000 line of credit. So again, this higher balance is going to accumulate, but this will accumulate as well. Now, the third neighbor, which couldn't get a line of credit, his interest is going to start accruing at this balance and go up. Now, you may ask, well, if he didn't get a line of credit and he has this $250,000, why didn't he just get a fixed rate? Because a fixed rate wouldn't expose him to more negative interest and it would have been a fixed rate. Well, that could be a conversation we have on a case-by-case basis, depending on what the goal of the borrower is and what the scenario is and what the advantage to him is. The fixed rate is an advantage because it won't move and fluctuate, but it's a disadvantage because this line of credit that he doesn't have now, if he decides down the road that he took some money out of his investments, let's say he had some 401k money or some IRA money, and if he took that IRA money and 401k money and he had to pay taxes on it, then the question becomes, is there a tax benefit to paying off some of this money, to lower it, to move some of this so that he now has some money on this side, which is a line of credit. In other words, with getting the adjustable, you have a lot more flexibility, and this line of credit can allow you to move the money back and forth, depending on what your financial advisor's decision is, or what your tax basis is, or if you need flexibility. So it's good that it does this, because depending on what your needs are and your flexibility of what your goal is, you have this. So even though this is zero right now, down the road it could be a situation where he pays this down and this becomes a standby line of credit for him as well. But obviously when we do it up front, we really have a conversation around, if you don't think this is going to be advantageous to you and based on what your needs are, should we look at doing a fixed? So that's a one-on-one conversation. Now, the third factor is the borrowers. The starting age for the FHA program, the home equity conversion, what is commonly known as the reverse mortgage, is at 62. Okay, so here I put the example, the husband is 68, his spouse is 58. Now, because the husband is 68, he meets the 62 requirement. He's over here. But because the wife is 58, she's outside of the program parameters. But because the husband qualifies, she's basically qualified because of him. But if the husband had passed away and she wanted to get the reverse mortgage and she was only age 58, she couldn't qualify because she's not 62. Now, this has another consequence because of their age difference. The husband is old enough to qualify because he's 68 and the qualification is 62. But when we do the loan and when we determine the loan amount and we determine the proceeds, we are using the wife's age, the youngest borrower, who in this case is 58. Now, because she's younger, it's obviously more likely that she's going to live longer, and that's what this line is. Okay, so if we start at 58 and we do the loan at 58, then the wife's expected life is going to be more than her husband, who's 10 years older than her. But fundamentally, the dollar amounts and the loan determination and the balance is going to be based on the wife's. Now, the consequence of what's happening right now with the Fed interest rate, and when I speak to clients, the sense of urgency is the following, is that when property values are coming down, when interest rates are going up, this already is getting less money on the loan. And if you have two borrowers that are not close in age and there's a significant age difference, the younger of the two borrowers is the third factor in addition to these two things that are happening that can potentially affect the loan amount being lower than higher. Now, this wasn't the case 6 months ago because property values were increasing, interest rates were low. So even if you did have one spouse being younger, it didn't affect the loan amount because you still had the property values higher and the interest rates lower. So that's where the sense of urgency comes, because Chairman Powell has already indicated that he's not happy with the interest rates where they are right now in terms of making the significant impact that he wanted on inflation. And they want to press the inflation to come down to 2% from its current 8%. And really the only tool that they have is the interest rate adjustments and to tinker with that and keep increasing that. Well, that affects how much money you get here. And for a borrower in case number one and case number two, where borrower number one doesn't owe anything and borrower number two can pay off their mortgage, the consequence is that they'll get less money, so their starting line of credit is going to be lower than it would have been before. but they still can benefit from the reverse mortgage because they're going to not only pay off their existing mortgage, which means have cash flow and be able to still have the line of credit. And if you have this line of credit in place, even though it's a lower amount than it would have been given to you before, the compensating factor is that because of this higher interest rate market, this higher interest rate environment that we're in, that higher interest rate is going to boost the line of credit to grow and to increase faster. So if you think about it, if rates before were 3%, they may have gotten $400,000 before. But now that interest rates are 6% and he's getting $300,000 instead of $400,000, that 6% on $300,000 can take a little bit longer, but it can also catch up to the money that's left on the table. So there is some compensation, but you can only take compensation as a benefit in this situation if you're in the first or second position where you have a nice large line of credit. If you start off here where all we do is pay off your mortgage, then it could put you in a position where you have less available, and based on how much money you owe on your mortgage, we have to determine if there's even enough money to be able to pay off your existing mortgage. So that's why in this case there's a sense of urgency and time is of the essence. But I wanted to kind of play all of the parts and go a little bit deeper so that you understand when if we have a conversation or you speak to another loan agent, the factors that go into it are not what you're used to. And that's what I'm going to do tomorrow, which we go over a little bit more of a comparison and relate it to where things are, and then between the two kind of give you the scenario of why it doesn't have to affect the long-term value or depreciation of the house in terms of equity as much as you think. Excuse me. So that's it for today, and I hope this was a little bit informative in terms of giving you some of the mechanics of not just the three factors that go into it, but more importantly, the compensating factors of what's happening behind the scene and the sense of urgency. Thank you for watching. I hope this video was something that you could share with others and answer some of their questions. If I can help out, please reach out to me. If you like this video and you like to subscribe, it'll help increase the visibility of these videos for professionals and other seniors. I thank you for your time. I thank you for being my client. God bless you, and see you tomorrow. Have a good night.